Continental conflict. European leaders clash over Greece. Get shorty. Investors place their bets against Facebook. And the business of barbecue. The price of a summer burger will make you flip.
Live from Bloomberg headquarters in New York City, this is InBusiness.
Hello, everyone. Welcome to InBusiness live from Bloomberg headquarters. I'm Trish Regan. Well, we want to get a check on these numbers right here in these markets. You can see the S&P, the Dow, and the NASDAQ trading just a bit lower right now, with the NASDAQ there off almost 0.5%, really leading the losses there. Dow Jones Industrial Average off 18, S&P off almost 1 point. A lot of concerns still right now over Europe. Let's get right now to our top stories. Costco's gross margins improved for the first time in more than a year, boosting profits at the retailer. The Warehouse Club posted 89 cents a share in third quarter earnings. That was 2 cents better than analysts' estimates. And HP shares are rising on news of its restructuring. CEO Meg Whitman is slashing 27,000 jobs. That's 8% of the workforce. She's streamlining its businesses. The company also posted 98 cents a share in earnings in its most recent quarter, better than the 91 cents analysts had been forecasting. And Martha Stewart has been named non-executive chairman of Martha Stewart Living Omnimedia, the company she created. Stewart rejoined the board of the company in September after being banned for 5 years as part of her settlement with regulators over insider trading charges. Okay, we want to get a trader's take on this morning's market action, so we're heading down to the NYSE, where Mike Shea of Direct Access Partners is standing by. We have John Brady, Senior Vice President of R.J. O'Brien. He's at the Merck. And in Chicago, Mr. Ira Epstein. He's with the Lynn Group. Okay, Mike, beginning with you, a little bit of an edging lower that we're seeing right now in the markets. Would you say this is still mainly attributable to Europe?
Yeah, I think so. I was actually surprised after every piece of data that came out this morning that we were actually trading up. Futures were up all morning, and I was trying to find a really good reason for it. I think the trading action that we're seeing today is really more reflective of what's going on. Our durable goods orders were, you know, they were not wow numbers. Our jobless claims numbers were not wow numbers. You know, Tiffany's getting hammered because they're following that trend of retailers that are forecasting less of a year than people expected. Costco really bucking that trend, but really generally that entire sector between last week and this week has not issued glowing forecasts for the rest of the year. You know,
Mike, but we've been seeing a very interesting trend as of late, in which during the last hour of trading, over the last couple of days, we've really bounced back significantly from the lows that we've seen earlier in the session. Could this be a continuation of the little bit of optimism, or maybe even short covering, that we saw in yesterday's session late in the day?
Yeah, you know, it definitely could be that. And the fact is, you know, every market technician that I talk to, and I talk to a lot of them, since February, since March, they've been looking for a retest of the 1275, 1280 level. It's all they've been banging the table on, and frankly, they've been a little bit wrong, and they finally got that retest. The market's probably due for a bounce too.
Okay, John, your take on today's market, and what are you seeing in terms of fixed income?
Well, I think there are two things, Trish. First, to answer your previous question, I think stocks were just oversold in the short term technically, and they've bounced, but they've also found their leggings with a strong performance in European credit default swaps, where those spreads have tightened, and also some rather dovish comments by EC President Draghi, who has suggested pretty openly that there will be more ECB rate cuts perhaps as early as early June.
Well, it's about time, right? I mean, John, hang on right there, because that's a very interesting point to me. I've got to say, it's about time. I don't understand why we haven't seen a bigger devaluation of the euro at this point. Do you anticipate that we could see parity, perhaps, with the U.S. dollar sooner rather than later?
I think parity is going to be a bit of a stretch. I think maybe a trade down to 112 to 114 dollar-euro, let's say, between now and year-end is a little bit more feasible. Parity would be quite a shock, and I think a lot of the bad news in Greece, Trish, is pretty much built into the market. You know, you continue to hear whispers from the sidelines of some sort of exit plan for Greece, and I would almost argue, too, that if Greece were to leave the euro, it'd be great for risk assets, as it would provide visibility and transparency for markets looking forward.
I don't know about that, John. I got to say, I worry that you're going to see a run on banks, and that, you know, if you're in Spain or if you're in Italy, the first thing you're going to do if Greece leaves is you're going to take your euros out of that bank, and they're going to have a real contagion issue that they're going to have to deal with. I don't know how much of that is priced in at this point. We may disagree on that. I want to get over to Ira quickly because, you know, commodities, they certainly have not been doing well as of late. How much of that is China? How much of that is Europe? How much of that is just a slow, sluggish U.S. economy?
How much of it is what you're saying, Trish? The run back to the dollar because they're petrified of what's going to happen if Greece leaves. They're worried about what the ECB is going to do. Everybody wants them to cut rates. They haven't done it. And you're right. If everybody spooks themselves, then the euro comes down. What happens is the dollar goes up, commodities priced in dollars, as we've seen in gold and silver and copper, get hurt. And let's face it, China, America, and Europe, their economies are not doing well. So what you've got is industrial metals under a lot of pressure right here, and I think you're hitting it. There's fear, and the fear is not relating to buying, at this point, gold. They're buying treasury instruments. They want safety of principle, not risk yet.
It's very interesting. And Ira, you know, it's funny because, you know, the ECB can do a lot to promise liquidity and say, we're going to be here, we're going to backstop all of this, but it's still very hard to change public sentiment. And once people get scared, that's a hard thing to reverse and a hard thing to predict. All right, we're going to have to leave it there. Gentlemen, thank you so much. Appreciate you being with us. Okay, Facebook, once again in focus today. Investors getting their first chance to short the stock just days after that disastrous IPO. We've got Dom Chu, who has the very latest from our markets desk. Dom.
Yeah, that's right, Trish. Let's start off with the intraday chart of Facebook shares, because we are seeing a bit of a pop today, at least about 2% to the upside earlier this morning. But the intraday chart is interesting because what you're seeing here is perhaps a little bit of fading here, a little bit of losing the momentum here. But of course, markets overall are feeling that same kind of loss of momentum. But what's important, like you said, Facebook shares perhaps going to be exposed a little bit more to downside pressure as short sellers are able to come into the marketplace. Today is an important day because it marks the day after Facebook shares that traded on the IPO have actually settled into client accounts. Now they're available for some investors to borrow and then sell short. The more shares that are sold, the further a price goes down. So that's something we want to watch for as this becomes interesting. Now, what's also interesting is how traders have been trying to take short views on Facebook stock over the course of the past few days when they haven't really been able to short Facebook shares. They've been doing other things like trying to short or buy put options on Zynga, LinkedIn, Pandora, other internet-related names. But now they have a chance to kind of maybe do it on a pure play basis. The rub here, though, is going to be how many shares are going to be available to actually short, available to borrow on Facebook. The fewer shares there are and the more demand there is to try to short them, the more interest it'll cost you to borrow those shares to actually short. So much interest, perhaps, that some hedge fund managers and traders say that it may be cost prohibitive to short the actual stock. That's something to pay attention to. Also, I spoke to Stephen Ehrlich, who's the CEO of Lightspeed Financial, a broker that specializes in trading for some high-speed trading clients. Says that you have to watch what's not only happening today, not so much today, but also what happens on Tuesday, because, Trish, that's when the options market kicks off on Facebook shares. So that'll be interesting no matter what. Liquidity in this stock is pretty big right now. It's already traded around 11 million shares. That's more than some other big names in the NASDAQ that are liquid, like Intel and Microsoft. Again, 11 million shares have already traded so far, and we're only in the first 40 or so minutes of trading here, Trish. One other thing to focus on, though, is whether or not the value justifies shorting it. We spoke to Stephen Spencer, who is one of these proprietary trading firms that does this kind of thing with Facebook. He had some interesting things to say here. Take a listen to what he said.
I'm going to take a look at the price action today, and that's going to probably largely dictate whether or not I take a short position. Ideally, I would have been able to short it on Friday or Monday when it was still trading in the high 30s, $40 a share. There was about 15–20% of downside from there. The risk reward on the short may not be as great down here.
So, Trish, it's going to be about valuations. Maybe after having opened at 42 and gone all the way down to 32, there are some investors who may characterize this as a quote-unquote value, Trish.
Well, we shall see. We spoke to an analyst the other day, Dom, first one to issue a sell, who said he really saw the valuation closer to 30, but nonetheless an interesting story, and we're going to continue to watch it. Thank you for your contribution there. All right, earlier today, the euro dropped to its lowest level since July 2010 on speculation that EU leaders won't be able to solve Europe's sovereign debt puzzle. Sarah Eisen is joining us right now for the very latest on the euro. Wow, $1.25. And maybe lower soon.
And maybe lower soon. We're watching it very closely. Euro really in the driver's seat right now when it comes to markets around the world. We spoke earlier with John Taylor, the CEO and founder of FX Concepts, one of the big currency hedge funds out there. He says, don't be surprised to see a bounce. It's looking a little oversold in the past few days, so you could see it go up here, but then it'll resume its slide. And he's one of those who's been calling for parity. I know you just mentioned with the traders, €1 to $1. He expects that Greece will have to leave the euro by this summer.
Wow, I mean, that's really interesting. Jeremy Siegel on just the other day saying the exact same thing in terms of parity. He saw that happening sometime within the next 6 months. I guess one of my questions is, and now they're starting to talk about it, but it seems like the ECB is a little late to the party on this one. Why not start to print? Why not devalue the euro? It's amazing to me in some ways that it's still that much more expensive.
Well, I mean, you get at an important point that you hear from investors and strategists all the time, that the European Central Bank is the only game in town. ECB, meanwhile, trying to put it on the politicians. Mario Draghi speaking just this morning, taking the opportunity again to call on the politicians to work toward a more unified Europe. That's really what it's about. And we come out of another summit meeting overnight in Brussels, 18th meeting. No decisions. I mean, the European leaders told us not to expect anything. They delivered on that. They didn't give us anything except for more clashes. And this point about euro bonds is important psychologically for the markets because it represents some sort of end game toward the fiscal unity that the investors and the bond market is demanding right now. So far, German Chancellor Angela Merkel is still against it. I love this quote. You're going to love this from Jean-Claude Juncker, who's the head of the European finance ministers. He said, the discussion about euro bonds was not unheated. There's a political way of saying that they don't have agreement yet.
You know, without a doubt, I mean, the politicians do need to get their act together, but that seems almost more challenging than the ECB's ability to say, okay, we're going to just have to have some kind of proactive approach. If we devalue the currency, at least maybe that gives some of these economies a better shot of competing on a global scale. Maybe they can actually start exporting more because their goods are that much cheaper. No country, no government, no central bank wants to actually say we're advocating for a weaker currency. But in this case, Sarah Eisen, might this be a strategy that works?
Well, certainly. And it would come along with more action from the European Central Bank. The view out there on the street, and a lot of big-name investors like Dan Arbeth of Perella Weinberg tells me this. The end game, the upshot here is the European Central Bank is going to have to come in a big way and ease, whether it's lower interest rates, another LTRO, another quantitative easing, because at some point this is going to break. Whether it's the euro, whether it's Greece leaving the euro, whether it's some sort of unification. As you said, we're already seeing deposits coming out of the Greek banks. I mean, at some point the European Central Bank will have to step in, according to some of the biggest investors and economists out there, and that could weaken the currency. And yes, that could be a blessing in disguise. As Nathan Sheets of Citigroup always says, why can't the ECB just out-QE the Fed? So that they can have a weaker
hey, the Fed's doing it. ECB wanted to catch on to this one. All right, Sarah Eisen, thank you so much. Buckle up, everyone. It's going to be kind of a rough road this summer, but maybe a good time for a European vacation. Okay, coming up, everyone's worried about Greece and Europe, but just how big a problem are they, in fact, for us back here at home in the USA? We've got two investment pros with very different opinions on how this euro crisis is going to play out in the U.S. They're going to square off for you right after this break. And later on, a tale of two PC makers, why Dell and HP seem to be on very different paths. I'll see you back here in 2. All right, everyone, welcome back to In Business. I'm Trish Regan. We're watching the S&P. The S&P has declined almost 4% in 1 month over all this uncertainty in Europe. Here with me are two chief strategists with different views, very different views on how this crisis in Europe could actually play out here in the U.S. Over in Philadelphia, we have Rob Morgan, chief investment strategist at Fulcrum Securities. He says Europe could fall off a cliff, and it won't impact the U.S. economy. And in studio, we have John Manley, the Chief Strategist, Equity Strategist at Wells Fargo Advantage Fund. Great to see both you guys. John, I'm going to start with you. You think it actually could have a big effect? I mean, we're talking a ripple effect. If things get bad in Europe, what does it mean for our investments here?
Well, I think it doesn't go through the economic system so much as it goes through the financial system. Yeah. You know, if A fails to pay B, then B can't pay C and D and all the way on down the road. So I assume they're going to try and stop it, but it has to be stopped. If it starts to tear, it could be like Lehman Brothers.
Let's think about how this would actually play out. So if Greece, when it comes to their elections, decides we don't want to be part of the Eurozone anymore, we want to go back to the drachma, that's the best solution for us, and they in fact do that, then the concern is maybe Spain's next, maybe Italy's next after that. And even if those countries aren't going to leave, don't you run the risk that there's going to be a run on the banks? I mean, if I were in Spain and I saw this happening in Greece, one of the first things I'd do is run and take all my euros out of my Spanish bank and stash them under a mattress somewhere.
So you have to throw money at it. You know, the central bank, the European Central Bank, the American Central Bank, the IMF has to literally throw money at it. You have to be proactive in this.
They can throw all the money they want at it, though, John, right? But that doesn't change public sentiment.
If you throw enough, it sort of forces the money back in. The banks become more and more able to pay the people who want the money, and there's less and less reason to take it out. If we draw a line in the sand and says it's not going to happen, you know, we didn't lose the U.S. banking system after Lehman. We did draw a line in the sand. We did stop it. So, but they had to be very proactive.
They had to be very proactive. But in the meantime, that ripple effect, even if it's a 48 hours, even if it's 2 weeks, even if it's a month, you anticipate that that's going to actually affect things overseas right here at home.
It raises worries. It raises concerns that, as I said, it spreads through the financial system.
Okay, Rob, tell us why you think John is wrong. Why is it going to stay contained in Europe?
Well, Trish, I would agree with you and John that if there is a run on the banks, that the ECB does have to do what the Fed did during their Lehman crisis and provide liquidity to stop that. I would certainly agree with that. But they're drawing up contingency plans for just that reason. So back to the point of, well, then how does it get transmitted here? I mean, trade with Europe is only 1% of our GDP. And in my own mind, that's the only way that it could be transmitted here. And since it's a drop in the bucket, it's not going to significantly impact.
I'm going to stop you there, Rob, because I remember
earnings.
In 2008, as this housing bubble started to implode, people would come on and say, you know, housing, it's not that big a deal. It's 3–4% of GDP. In the scheme of things, it doesn't really matter. But it wasn't, in fact, housing that screwed everything up. It was the concern about problems in the banking system and a liquidity crisis that really messed it all up. So granted, no, I mean, we don't trade a lot with Europe. We don't rely heavily on exporting to Europe, but we do rely on the functionality of the banking system.
Well, I agree, Trish, but a big difference between the crisis of 2008 was the fact that we had so many securities in the system that we just couldn't value. And I think that's a big difference here. That is not really one of the problems that we're talking about. I think everything can be valued. Now a lot of, you know, if Greece drops out of the euro, that's a bad thing. But at least once that happens, uncertainty is taken out of our system, and probably our stocks rally.
How is uncertainty taken out of our system? Because if Greece drops out, doesn't that mean you got a good shot, John, of Spain dropping out?
Well, I think no. I think they'll try and stabilize that, but you just don't know where it shows up. That's the thing. People think they know where their trades are. They didn't. And when I talked to
so maybe this is that Lehman moment. In other words, you know, I can remember the live trucks being in the television business going from Bear Stearns to Lehman Brothers, where they spent a lot of time, to Morgan Stanley, even showing up at Goldman Sachs. But in other words, we're containing it after Lehman. Maybe Lehman is Greece, Greece is Lehman, that kind of thing.
I think the central bank has to work on that assumption. I mean, you know, let's say that there's only a 70% chance things blow up. Well, you still have to act on that assumption. You have to assume that it's going to be very bad unless you do something, and then you put a wall of money between you and investors.
All right. Looking forward to that wall. Thank you so much for all your insight, Rob and John. Appreciate it.
Thanks, Trish.
All right, coming up, jobless claims, durable goods. We've got all the latest numbers for you to take a look at the U.S. recovery. right, here on InBusiness, we like to keep track of all the cool jobs for you. So today's job puts you on the road to success for Porsche. Porsche Cars North America are looking for a public relations specialist. In this role, you will coordinate all event logistics and facilitate national and international media coverage. You would work with the general manager of PR, and you should have a background in business and PR. Knowing the German language, also helpful. To apply, go to Porsche.com/USA and click on Jobs and Careers. We're back talking HP and Dell.
Live from Bloomberg headquarters in New York City, this is InBusiness.
Welcome back to InBusiness, everyone. I am Trish Regan. We are 1 hour here into this session. We want to get a brief check on markets. No real stellar standouts on the economic front. We did get jobless claims coming in today, durable goods. All that pretty much is expected, but we're looking at a market that's trading pretty much near the flat line right now. Still, ongoing concerns about Europe, ongoing concerns about Greece. Will it, in fact, leave the Eurozone? That's what traders are debating, but we are looking at markets that are holding steady right now. We want to get to our top stories at this moment. Facebook shares, they are expected to be under even more scrutiny today as short sellers will be allowed to trade for the first time since the IPO. The stock has fallen sharply, and it's estimated retail investors have lost as much as $630 million since the company went public. Tiffany cuts its full-year profit forecast, as sales in North and South America were less than expected. The retailer expects sales this year will be up 8%. It had previously forecast a sales increase of 10%. And Goldman Sachs is holding its annual meeting today. James Johnson, the company's longest-serving director and compensation committee chairman, is up for re-election. The investment firm that helps oversee the almost $6 billion Sequoia fund has already publicly opposed his re-election, citing, quote, egregious corporate governance debacles. All right, for more on the individual stocks that we're seeing some movement in the markets right now, we want to head down to Alex Steele. She's on the floor of the New York Stock Exchange for us, and it looks like we've moved into the green.
Yeah, it's a real push and pull here today, Trish. Traders fading those early morning gains somewhat, but holding steady. Do want to point out, though, that banks and Apple are both lower right now, and traders tend to look at those two areas for direction in the market. In the red, we have tech, energy, and financials. The biggest decliner in the S&P is actually NetApp, falling to its lowest level since November 2009. Take a look at that, down almost 13%. This is as the company significantly lowered its first quarter earnings and revenue guidance versus estimates. Stock also getting slammed with a downgrade RBC Capital. On the upside, you do have materials hanging on to gains, helped by names like Dow Chemical. The company awarded over $2 billion in damages from Kuwait after it canceled a 2008 agreement to buy a stake in the company's plastic business. But really, it's utilities and consumer staple stocks gaining the most today as investors rotate into that safety. Costco up there almost 2%. That's after third quarter profit tops estimates, and margins improved for the first time in more than a year. And the one big mover here we want to point out, Trish, is Pandora. The company only lost 9 cents a share in the first quarter versus the 18 cents loss expected, mainly due to higher mobile advertising sales. 55% of the company's ad sales came from mobile devices. Also want to touch on gold here, up now about $24, climbing the most in a week. Central banks bought gold in April. Turkey bought almost 30 tons, and the weaker dollar also helping. But gold stocks, which outperformed the metal yesterday, really struggling here. You see there Nova Gold, Junior Explorer in the red, and Newmont pairing earlier gains up just about 1%. That's some of the early movers we're watching here. Trish, back to you.
Alrighty, Alex, thank you so much. Well, there is, unfortunately, a laundry list of headwinds that global investors are facing right now. Scarlet Fu, she's narrowing it down to 4 potentially destructive scenarios. Okay, Scarlet, what's number 1?
Well, Trish, Michael Crofton of Philadelphia Trust put it best in describing how the big picture is driving every tick across assets these classes. Listen up.
There are 4 horsemen of the macro apocalypse, okay? Europe, China, Iran, and America, in that order. I mean, as we get towards our election, that could be a real problem.
So let's break down Croftsman's four horsemen. First up, Trish, Europe and a potential Greek exit from the euro. It's the biggest known unknown for investors, but there is a deadline in place with the Greeks heading to the polls once again in just over 3 weeks. Then you've got China. The economy slowdown, I should say, is deepening, and proof of that came in a private survey last night, which showed manufacturing may shrink for a 7th month. We know that Beijing has confirmed stimulus will come, but fears over a potential hard landing persist. Now, the third horseman is Iran's nuclear ambitions. Talks with the U.S. and other countries may be underway, and some of the geopolitical risk premium has come out, with NYMEX oil at about 90 and Brent at 105. But all of this, traders tell me, could turn on a dime. Then you've got the U.S. economy. It's losing momentum, and the November election is distracting policymakers from addressing the fiscal cliff, the expiration of the Bush tax cuts, and more than $1 trillion of automatic spending cuts at year-end. Consumer and corporate confidence hang in the balance here, which is why there's a relapse of the uncertainty that plagued markets in 2011. Everyone's piling into U.S. and German debt. The euro and commodities are hovering near 2-year lows, and global stocks have given back almost all of their first quarter rally. Trish, Crofton predicts the S&P 500 could fall another 5% from yesterday's close to 1250 before it eventually finds a bottom.
My goodness. All right. Scarlet Flu, thank you very much for that. In our Latin America report, General Electric has invested $300 million in Brazil. Billionaire Batista's EBX Group. The deal means GE is going to get an 0.8% stake in Batista's company. Batista wants to boost foreign shareholders in his holding company. And Brazil is looking a little behind schedule for the 2014 World Cup tournament. The sports ministry says the country has broken ground on barely half the tournament's planned infrastructure projects. Construction is underway or completed on only 60 of the 101 stadium, public transport, and airport projects. Rising construction costs and labor disputes are to blame. All right, now as we go to break, let's take a look here again at how the major indices in the region are faring today, at least in Latin America. Let's look at the Mexican Bolsa Index trading up 0.5%. In Sao Paulo, moving down 0.3%, while in Chile, in Santiago, you're looking at a 0.7% gain. I'll see you in 2 minutes. All right, as the West Coast wakes up, we are taking a look at tech stocks that are in the news today. We're watching NetApp after ISI Group analyst Brian Marshall said it may be an acquisition target for Oracle or IBM. The reason, what Marshall calls, is cash hoard. RBC Capital also downgrading the company. You can see shares there trading down pretty considerably, off 13%. Pandora shares, they jumped after first quarter results topped analyst estimates, particularly in mobile advertising. 55% of the $70.6 million in ad sales were from mobile devices. Pandora shares, take a look at that, folks. Up almost 18% right there, a gain of $1.83. And we are watching eBay. After it was announced its PayPal service will be available at some brick-and-mortar stores this holiday season. eBay has signed a licensing and marketing deal with Verifone, the largest maker of credit card terminals, and you can see investors like it. Shares up 1.6% on eBay. Well, we got one stock that's bucking today's tech sell-off, HP, Hewlett-Packard, the PC giant, cutting 27,000 positions, but also says it's, quote, cautiously optimistic about its future. This just after competitor Dell posted some pretty awful numbers. Sheila Damaranjan joins us right now to tell us how the two companies are on pretty different paths here, two contrasting paths, Sheila.
No, absolutely, right? Call it the tale of two PC makers. Investors right now absolutely speaking with their feet. So you talked about Hewlett-Packard stock. That is soaring today. Dell pretty much doing nothing today after falling 18% after that terrible earnings report. You know, a lot of people are saying this is really a case of show me stocks, right? You have HP here. Meg Whitman is showing the street that she is willing to actually go out there and make some big moves, make some bold moves, restructure. People like that. They like the decisiveness. Yes, the jury is still out a little bit if Solvit's going to work, but we are starting to see signs of stabilization. So if you take a look at the numbers they actually reported yesterday, second quarter profits and sales, they fell. Yes, but they were better than what the street was expecting. Third quarter profit as well, a little bit below what the street was expecting, but the outlook for the entire year was good. And you mentioned those 27,000 positions. There's one thing that Wall Street likes, it is cost savings. How about $3 to $3.5 billion of them by 2014? So a lot of good things happening for PC. It wasn't a great quarter, right? It wasn't some sort of blockbuster quarter, but it was enough to make investors wait around and say, you know what, we're going to wait here and see what happens with this story.
But the outlook was key, right? I mean, the fact that things are getting better as opposed to gloomier or worse. I mean, that had a big role in people's optimism about the stock, at least that we're seeing today.
Huge part of it. I mean, she actually said, look, we're cautiously optimistic about the future. We are on our way to stabilizing, and that's where the key difference really is with Dell, right? Here is a company that came out, cut its entire forecast for the year. At this point, analysts are saying this is a show-me stock. They got to do something to really fix the business. And yes, they've been talking about this transition away from PCs to more services. Here's the problem, though. Dell's business right now, 70% exposure to PCs. Compare that to HP, which is only 30%. The Dell story is going to take a lot longer to turn around, a lot more question marks if they're going to be able to turn it around.
Well, HP also has a pretty strong printer business.
Yeah, they do have a strong printer business. That was one of the points of weakness, but certainly it will help them during their times of adversification. I want to point out one of the things that people now always talk about when you have a stock that fell as much as Dell, is it going to be a takeover target, right? Are people actually looking at it saying, hey, this could actually be some pretty good value? I got to tell you, I talked to a lot of analysts about this. Everyone's saying an acquisition is probably not in the cards for Dell. In fact, they said, the problem is who wants to go out and inherit all of Dell's issues, right? It's a pretty big issue. It's not like any companies want to go out there and take them on their own. Well, so don't forget Michael Dell. He owns 15% of the company now. No deal is going to happen without him.
All right. Well put. Thank you so much, Sheila Damarajan. Coming up, jobless claims, durable goods. We're going to hear from a chief U.S. economist. He's going to tell us if all this economic data is strong enough to keep the U.S. away from Europe's drama. And how about this, the barbecue economy? We're going to look at the rising price of meat just in time for Memorial Day weekend. Okay, this morning we learned that orders declined for a second straight month when it comes to durable goods. Meanwhile, you had jobless claims out. They were little changed, falling to 370,000 last week. For more on what these economic numbers mean and whether it's going to be enough to weather the European crisis, we're joined by Tom Porcelli, chief U.S. economist for RBC Capital Markets from the trading floor there at RBC in New York. Tom, good to see you. So your reaction to today's numbers?
Well, I think if you look at the durables numbers in particular, that the CapEx proxy would suggest to you that you're looking at some downside risk in CapEx in the second quarter. We had already built in a pretty modest outcome, but I think what we have to recognize is this was an April report, so you've just started out the quarter on a very soft tone. As a result, we think there's some downside risk. But again, for us, we were already pretty far below consensus. We're 1.5% for the quarter. So we're not going to adjust our numbers at this point, in part because I think you have to remember next week you're going to get the second look at first quarter GDP. So if there are any big revisions there, there's a handoff issue. So we'll just wait until next week before we adjust.
Talk to me a little bit about, a little more about jobless claims and how that's affecting your read on employment, where you see the unemployment rate heading, and where you see the jobs being added in this economy right now. How many for this month?
So I think when it comes to the claims number, I think what everyone has to sort of bear in mind is claims only capture one side of the equation, right? They only capture firings. They don't capture hirings. And the one thing that I think we've been very cognizant of is it's not really the firing side of the equation that we're really worried about. It's really more of the hiring side. So we're rather dismissive, actually, of claims just in general, even when they were making their big move down. And recently, now that they've been rising back up, we're basically telling investors, don't really follow claims. Just look at the simple change in jobs. And that's true for the unemployment rate as well. The unemployment rate is a terrible indicator right now of what the labor backdrop looks like. It's being influenced by the labor force. And because you have these wide fluctuations in the labor force, the unemployment rate has actually fallen. If you actually kept the labor force actually rather steady, the unemployment rate would still be up around 10%. So again, we're very dismissive of that as an indicator. The best thing to look at is simply the change in job growth, and what we know is that over the last 2 months, the change in job growth has been very, very abysmal, averaging only about 135,000.
And do you anticipate that's going to continue as we move through the summer, this abysmal, anemic job growth?
Yeah, we do actually. You know, our average for the year was anywhere between 150 and 175. We think we're going to come in right around that. The one thing I would say is, so the summer, again, we're not looking for any meaningful deviation from where we are today over the course of the next few months. But the one thing I would say watch out for is toward the end of the summer and even going into, say, you know, toward the back end of Q3 and into Q4, because guess what happens then? You're then all of a sudden going to have the same conversation that we had last summer about the debt ceiling, possible debt downgrade. You're going to be talking about the fiscal cliff in a much more pronounced way. And just remember what happened last year when we were talking about all these things. Basically, hiring seized, consumption seized, CapEx seized. So we're looking at what we think is going to be a pretty soft second half of the year.
Yeah, in other words, CEOs start to get really nervous when they hear all that talk, a little more reluctant to invest in people and in infrastructure. What about durable goods? Everybody had been talking about this renaissance and emerging in this renaissance in manufacturing, but in fact now we've seen 2 months of declines in durable goods orders. What do you make of that?
Yeah, I think what people have to recognize is a renaissance is, to me, it's a very lofty word. I don't think you can have a renaissance in manufacturing. I think that you can see some stabilization and even some modest improvement in the overall manufacturing complex. But I think generally speaking, in terms of manufacturing jobs as a great example, you know, manufacturing jobs have been in a secular decline for the last 30 years. Manufacturing in terms of GDP represents about, it's 10% of GDP today, where, you know, it was 20% more of GDP back several decades ago. So I think calling it a renaissance is an absolute exaggeration. But again, I think, sure, manufacturing is stabilizing, but at just unfortunately very low levels.
Okay, so we're looking at a very low growth scenario, in your view, for the U.S. economy. What does this all mean when we stack up all the concerns in Europe against what we're seeing here in the U.S.? In other words, if Greece pulls out of the euro, if we start to see real problems there on the economic front, on the liquidity front, what is that going to mean for us? Are we strong enough to insulate ourselves from Europe?
No, so I think this goes to the idea of decoupling, which we think doesn't exist. I think if, you know, you could do this very simply. If you just look at a bunch of countries' GDPs, just combine them all together, if you look at the correlations of these GDPs, what you'd actually see is that the correlations are rising. They're not falling. So decoupling, in our view, does not exist at all.
Well, what about the thought that it's such a small percentage of our overall exports and overall GDP? I mean, we don't rely on Europe as one of our key markets.
Well, so this is exactly the direction I was going to go in. So when you think about the transfer mechanism from Europe to the U.S., it actually does relate to the trade channels, but it doesn't relate to our direct trade between the U.S. and Europe. Instead, it has everything to do with our trade to emerging markets. And this is an idea that we were talking about months ago when this conversation came up toward the end of last year. I think what people have to recognize is if you want to make an argument for how Europe is going to impact the U.S., what you have to keep in mind is what happens to the financial system there. And the reason I say that is the European banks do the bulk of lending to emerging markets. And guess who our biggest trade partners have been in terms of growth rates thus far over the recovery? They've been emerging markets. So if all of a sudden the European banks seize up and emerging markets start to lose one of their key sources of financing from a trade perspective, then that's how the U.S. gets hit. Because the truth is, in the U.S., we're not a big exporting country, but exports have accounted for over 50% of economic activity over the course of the recovery.
Interesting. So we cannot be insulated. All right. Interconnected world. Tom Porcelli, thank you so much.
Thank you.
Coming up, meat prices. They're rising just in time for the rising demand tied to grilling season. We're going to look at the impact on the barbecue economy. And does the U.S. need a dose of austerity so it doesn't go? For those of you getting ready to fire up your grill this coming weekend, well, cost of your barbecue, get ready. It's going up. Scarlet Foods at the touch screen with more on these rising prices.
That's right, Trish. And off the charts today, we're going to start with a drop-off in the supply of meat in the United States. Because according to Tyson Foods and the Agriculture Department, domestic meat on grocery shelves has dropped about 30% since 2000. These are your white bars right here. And the reason is because of increased cost of production and more meat exports. So as a result, wholesale meat products, and here we're talking about beef, pork, and poultry, are up 18%, the yellow line. Now, the fact is that we are eating less meat here in North America, while the developing world is actually eating more of it. Since 2001, meat consumption in the BRIC nations, Brazil, Russia, India, China, has climbed 22%. Meantime, consumption in North America has dropped 3%. Let's try that again. Has dropped 3%. But you don't want to be fooled here by all these numbers, because the fact of the matter is, on a per-person basis, North Americans are still eating 3 times as much as people in BRIC land. And that only means there's more room for those countries to increase demand, which would most likely lead to higher prices. And that is today's Off the Charts. Trish?
Neat stuff. All right, thank you, Scarlett. For a quick programming note for you this week on Rewind at 8 p.m. Eastern, Matt Miller and Gigi Stone will be showing us how many of Wall Street's most powerful men and women may be spending their summers. And tonight, Matt and Gigi meet with celebrity realtors and tour vacation homes in the Hamptons worth over $30 million. Don't miss it. It's coming up tonight on Rewind at 8 p.m. That's it for this hour of In Business. Coming up in the next hour, who is unfriending Facebook? We have answers from attorney Peter Saperstein. For those of you getting ready to fire up your grill this coming weekend, well, cost of your barbecue, get ready. It's going up. Scarlet Foods at the touch screen with more on these rising prices.
That's right, Trish. And our Off the Charts today, we're going to start with a drop-off in the supply of meat in the United States. Because according to Tyson Foods and the Agriculture Department, domestic meat on grocery shelves has dropped about 30% since 2000. These are your white bars right here. And the reason is because of increased cost of production and more meat exports. So as a result, wholesale meat products, and here we're talking about beef, pork, and poultry, are up 18%, the yellow line. Now, the fact is that we are eating less meat here in North America, while the developing world is actually eating more of it. Since 2001, meat consumption in the BRIC nations, Brazil, Russia, India, China, has climbed 22%. Meantime, consumption in North America has dropped 3%. Let's try that again. Has dropped 3%. But you don't want to be fooled here by all these numbers, because the fact of the matter is, on a per-person basis, North Americans are still eating 3 times as much as people in BRIC land. And that only means there's more room for those countries to increase demand, which would most likely lead to higher prices. And that is today's Off the Charts. Trish?
Neat stuff. All right, thank you, Scarlett. For a quick programming note for you this week on Rewind at 8 p.m. Eastern, Matt Miller and Gigi Stone will be showing us how many of Wall Street's most powerful men and women may be spending their summers. And tonight, Matt and Gigi meet with celebrity realtors and tour vacation homes in the Hamptons worth over $30 million. Don't miss it. It's coming up tonight on Rewind at 8 p.m. That's it for this hour of In Business. Coming up in the next hour, who is unfriending Facebook? We have answers from attorney Peter Saperstein.
Live from Bloomberg headquarters in New York City, this is In Business.
Hello, everyone. Welcome to the second hour of In Business. I'm Trish Regan. We want to get a check on the equity markets here in the U.S. Taking a look at those numbers, you can see the Dow now in positive territory by 17 points. S&P trading up to a little better than 0.1% gain there. NASDAQ still in the red, but just slightly. We did get some economic news out today in the way of durable goods orders, in the way of jobless claims. Neither were really stellar. Nothing to write home about there. So investors still primarily focused right now on Europe and what a potential exit of Greece from the EU might mean for all of us back here at home. We want to get right now to our top stories. And we're looking at jobless claims. They did fall by 2,000 last week to 370,000. This is according to the Labor Department. The drop points to a gradual improvement in the labor market. Goldman Sachs is holding its annual meeting today. James Johnson, the company's longest-serving director and compensation committee chairman, is up for re-election. The investment firm that helps oversee the almost $6 billion Sequoia fund has already publicly opposed his re-election, citing, quote, egregious corporate governance debacles. And Martha Stewart has been named non-executive chairman of Martha Stewart Living Omni Media. This, of course, is the company she created. Stewart rejoined the board of the company in September after being banned for 5 years as part of her settlement with regulators over insider trading charges. And for more on the individual stocks that are seeing a lot of movement right now, we want to head down to Alex Steele. She's on the floor of the NYSE for us. Hey, Alex.
Hey, Trish. So the S&P still flirting around that 1320 level here. Let's check out some of the decliners that are prohibiting any big moves here. EMC and VMware. VMware flirting with its 200-day moving average of 95.84. Now, Bernstein says there's a high risk of a meaningful slowdown in server virtualization penetration. What does that mean? Slowing growth for VMware, and of course EMC getting dragged down with that. EMC owns more than 80% of VMware. And Oracle also staying in this tech theme, kind of nursing its wounds today. This is after a jury found that Google did not infringe on Oracle's patents with its Android software. Oracle had been hoping to win the case and snag about as much as $1 billion in damages. And also checking in on Chesapeake Energy. The drama just continues with this company. Shares also lower today. The company rebuking an activist investor who was trying to get shareholders to vote against 2 board of directors up for re-election. Consider the fact the company has lost half of its value this year, facing a severe cash crunch, desperately trying to sell assets and securing a $4 billion loan in the meantime. And we got to check in on the winners here, helping to support the S&P. Got to hit on Hewlett Packard, stock popping the most in about 8 months. As this turnaround story really plays out, company making 98 cents a share in its last quarter, beating estimates, and is cutting 8% of its workforce to save as much as $3.5 billion annually starting in 2014. Now, Brian Marshall of ISI Group saying this is the first step in a recovery process. HP stock looking like a good place to start parking some money, and the shares already reflecting so much bad news. And this is helping to pull up some storage stocks like Seagate Technology. Other names like Western Digital and LSI were really fighting to stay in the green, but just could not do it. Seagate up over 3%, getting a little extra help here because it's buying a controlling stake in LaCie. That's a Paris-based manufacturer of consumer storage products. That's going to be for about $186 million, and that helps Seagate expand its business into Europe and Japan. That's the movers we're watching here. Trish, back to you.
All righty, Alex Steele, thank you very, very much. Well, the overhang for the financial markets, concerns, as I've been saying, about Greece leaving the euro, and one of the scariest scenarios of a Greek exit, the massive nationwide bank run that would precede it. Sarah, I know you've been looking into this angle. Fill us in a little bit more with some historical perspective of some of these bank runs we've seen in the past.
Well, you've seen the pictures from the 1930s, Trish, after the market crash, stampedes to withdraw money. Remember 2008, Northern Rock in the UK, IndyMac here in the United States. This time, it's not just one bank, but an entire country worth of banks at risk. The Greeks have already been moving money out of local banks to, quote, safer banks in places like Germany, worried their accounts will be worth less if they're having to be converted from euros into drachmas. The odds of that rising by the day. Now, in the bank runs, as banks bleed deposits, lending ultimately shuts down. Liquidity is literally sucked out of the country. So the question is, how can you tell whether it's already started? Well, there's no real-time tracker here for the bank deposits. The ECB data that we have is at least a month old when it is actually released. The best sign when central bank officials get panicked calls from private banks. And last week, Greece's central bank chief warned the interim president that his countrymen had pulled $800 million out of the banks. Just this morning, SocGen CEO said there's no tangible sign of a bank run in Greece, but look at that. That's the data that we have. It shows deposits in Greek banks have fallen by more than a third since 2010. Deposits in Spain have been falling too. So could a Greek bank run be stopped is the ultimate question. The regular response, central banks pumping liquidity into the banks to ensure that deposit holders get their money, just wouldn't work here because depositors aren't worried about whether the money is there, but what it will be worth when turned into new drachmas. Now, moving money to European countries with stronger banks ensures their wealth better than any deposit insurance ever could. And if you want a recent example of this, you can compare it to Argentina. To avoid total meltdown, what happened was the government froze bank withdrawals until all of the assets in the banks were converted. What followed? Chaos, unrest, and eventually the fall of the government. Clearly, Trish, Greece is a totally different beast here, and not even to mention the risk of contagion to countries like Spain and Italy once a Greek exit from the euro, if it happened, would be set as a precedent.
Well, Sarah, walk me through what we might see if, in fact, Greece does exit the euro. We go back to drachmas. I mean, would anybody even take drachmas? Might you see a scenario, a situation that could be similar to the days of the post-Soviet Union when you had a black market and it was really only dollars that were being exchanged because nobody trusted the rubles?
It's going to be a tricky situation for the European leaders no matter what. UBS put in a note this week that if Greece does have to go back to the drachma, it will be revalued as much as 75% lower than euros. And this is really the concern for the Greek citizens, why they would rush to take their money out of euros while they still can get the euros, move them over to safer places like Germany and France. You can bet when you hear European leaders saying they're talking about contingency plans, Plan B, this is one of them. And the real challenge here is they'd have to ring-fence Greece. Greece is a $200 billion economy, so that kind of pain, those kind of pressures, and those kind of risks don't spread to bigger, more worrisome places like Spain and Italy.
No, you're absolutely right. I mean, that's the big issue, because if you start to see bank runs in Greece,
right,
you could very well start seeing them in Spain. You could see them in Italy and elsewhere throughout Europe. We're watching it very closely. I know you are. Thank you so much, Sarah Eisen. Facebook, once again, ladies and gentlemen, in focus today. Investors getting their first shot to short the stock just days after that disastrous IPO. Dominic, too, has the very latest from our market desk. Dom, it's getting pretty expensive to short this thing.
It is getting pretty expensive right now, but let's start off, Trish, with really what's happening with the stock right now, because as I'm watching this right now, what you're seeing is the lows of the session here. We are still positive, but not by very much. We closed at $32 yesterday. We're just a hair above that right now. 32.02 has been the low so far today, so perhaps a little bit of buying support as we head towards 32. But again, some investors may be facing some headwinds if there is a renewed kind of interest here perhaps in shorting Facebook stock. Now, Facebook stock, like you said, this is the first real chance investors have had to really go in and borrow shares from other people and then short them. It's because people have had those first trades from the IPO finally settle. They can now lend those shares out for people to kind of make a speculative bet here on the short side. Now, what's really important about whether or not it happens today is we're going to be watching for spikes in volume. Right now, about 18.7 million shares have already traded in terms of Facebook here. That's more than the number of Microsoft shares that have traded today, more than the number of Intel shares that have traded so far today. So again, this is a very active stock. Whether or not it becomes even more active given the advent of this kind of short-selling era for Facebook shares remains to be seen. But of course, we're watching the price action down below. It's also a concern for valuation, right? Because obviously, we've seen a large drop over the past 4 days between the IPO and right now. And from peak to trough here, about some 30%. Maybe it's already reflected a lot of the perhaps short interest in terms of the downside in the stock. That's something that we spoke to a proprietary trader about earlier this morning, and he said it's a number of different aspects. Take a listen to what he had to say.
Now that it's come down to about $32 a share, I think people will be a little bit more cautious shorting it down at these levels. If it starts to trade below Wednesday's low, I think we're around $30.80. You're going to see some more selling pressure. There's an argument. Look, it's going to depend on the funds or the individual traders. Is it a technical outlook or is it a fundamental outlook?
So you're watching technical levels, which is the chart side of things. You're watching the fundamentals. Valuation still very much a company that's valued far and above and beyond the S&P 500 as a whole. But it remains to be seen whether or not we'll see this price action kick off. Remember, today's short selling, the big picture, says Stephen Ehrlichman, is going to become even clearer next Tuesday, because that's when the options market is expected to kick off on Facebook shares. And remember, as options start trading on this, the people who make the options, the market makers, the ones who structure call options and put options, in order for them to sell you one of those, they typically hedge on the back of that, and that involves, Trish, either buying shares or selling short shares, something to watch for as volume perhaps picks up into next week, Trish.
All righty, thank you so much, Dom Chu. All right, coming up, everyone, meet the face behind the Facebook lawsuit. We're going to talk to the lawyer who's taking on Facebook over its bungled IPO. And how about this? Does the U.S. need a dose of austerity so we don't wind up just like Europe? We're going to speak with Bloomberg View columnist Amity Shlaes. She says yes. If the U.S. does not want to go the way of Europe, it needs to adapt an unpopular term, austerity. For more on why growth can follow austerity, Bloomberg View columnist Amity Shlaes is here with me right now. Amity is also the director of the 4% Growth Project at the Bush Institute. A pleasure to have you back on Bloomberg TV. Amity, what do we need to wake up and realize here in the U.S.?
Make our government smaller. Often we call that austerity, and often we treat austerity like a bad word, but a smaller government with lower taxes correlates to stronger growth. The data suggests that over many decades in studies, and we just don't like to admit it to ourselves, so we don't say we're for austerity because that makes us sound bad, but austerity can be good when it's a budget cut. It can be good for growth.
Well, is there a lesson that we should be learning from Europe right now? An area that clearly didn't follow austerity.
Spending didn't cause enough growth to get them out of their budgetary fiscal shortfall. Spending is not the answer. One thing that's going on that we're noticing, Trish, is I think the U.S. is debating Europe because we don't want to debate us. It's
really?
sort of a proxy, right?
We can focus on them.
It's easier to talk about what's wrong with them, right?
And keep in mind, Amity, we've got a debt-to-GDP ratio that is actually worse than Spain's.
Right, and worse than Spain's. And in the olden days, we used to say we're the engine of growth. Well, we still are. A lot of this is the United States. So when people are nitpicking a tax rate in a foreign country, you want to ask, what about our own tax rates and our own prospects, the debt that's coming, the certain tax increases that are coming? This is a debate we need to have. It's not a bond market Europe debate. It's a U.S. debate.
And Amity, if we don't start taking some of our medicine and start taking some of this pain now, what is this going to mean for us and for future generations?
What it means is inflation and pain for future generations. But I don't view this all as pain. You can cut the tax rates simultaneous to cutting spending. You just have to do both.
How do you do that? How do you cut taxes and cut spending to get us out of this? Because a lot of people would say, all right, cut the spending, but at some point you may have to raise taxes.
Well, I'm just actually looking at the 20s because I'm finishing my biography of Coolidge, and they cut taxes 5 times, but they also cut the government in half. So that combo is unbeatable. He had twin lion cubs, Coolidge. One was called Budget Bureau, and the other was called Tax Reduction. They go together in a pair. Cut taxes, cut budget, not just one or the other.
Okay, so a lot of people, and we play devil's advocate with you, a lot of people say, yeah, the 20s, the problem is look what followed the 20s.
It's very hard to pin the blame for the 20s on the 1925 tax cut. We have downturns. We didn't have to have an 11-year depression. My book, The Forgotten Man, argues that the other way. It was the turn away from the 20s policies that made the depression great in magnitude.
So what do we need to be most focused on right now? I mean, we're so focused on Europe. Do you think we need to look inward and say, we need to get this right?
Well, if we had very attractive markets, very attractive bonds, very low tax rates, the money would flow here, and we would, by the way, improve Europe because they would have a stronger competitor in us, and they would live up to us. So I would look at the taxes, and I would look at the budget.
So what about these economists? You know, Mr. Krugman, Paul Krugman was on recently with me saying, we need to spend more. We're never going to get there if we don't spend more. What about economists who say, we need social programs, we need more spending by the government if we ever hope to get ourselves out of this malaise?
Well, I think they're in a pickle because academically they've built up that case, and once you've sunk costs into a concept, it's hard to go away from it, generally. So economists have taught themselves that spending is good. It can be good sometimes, but there's plenty of evidence that stimuli don't work. And there's a war on right now, and maybe even an implosion in the economic profession because they're realizing their data sets didn't work to explain the recent crisis. So you see a trade-in crisis. They don't really know what they're saying, and all sort of strange things are coming out of it.
Well, Krugman's advocating, for a debt-to-GDP ratio upwards of 120, right?
Right, but even that's a very strange thing to advocate, and that he's gotten himself, I don't want to just talk about people, but that he's assumed such an extreme position tells you about the desperation of the trade.
Okay,
of economists.
So what would be your prescription for growth and for fiscal health right now?
Work to balance the budget. If we try to supply side cuts can have an effect. If we reduce the capital gains tax very, very much, money would come here. But look at them in tandem. Cut the budget. Medicare Part D particularly, that's a problem. We have to revisit that. We have to revisit other entitlements. Be frank about it. Be frank about it with our children. I mean, this is a national discussion. It doesn't start with numbers. It starts with our obligation to our children and being frank with them about the fact that our entitlements overcommit to them.
No, well, you're right. I mean, it's a tough, politicians don't want to go near it.
But I'm optimistic.
It's too loaded. You're optimistic.
I'm optimistic.
We're going to get there.
I'm optimistic because people don't like to be lied to either. I think everyone will feel better when we begin to speak the truth about our economy.
We need to start having these conversations for sure. Glad you're on here today doing that very thing. Thank you so much, Amity Schlaze. All right, coming up, the race for dollars heats up. Al Hunt will tell us about the big push for big donors by President Obama and Governor Romney. We're back in 2 minutes.
Wherever this flag's flown, we take care of our own.
Turning now to the 2012 presidential election, President Obama courted potential donors yesterday in Colorado and in California in an effort to retain his edge in the money race with Republican presidential candidate Mitt Romney. For more on the race, the money race, we're joined right now by Washington editor Al Hunt. Al, always good to see you.
Hey, Trish.
Okay, so far, President Obama's got a pretty significant edge over Governor Romney in terms of fundraising, but with the help of the RNC, what do you think? Is Governor Romney going to be able to close that gap, and does the Obama camp need to be worried about all this money?
Well, they need to be worried in the sense that unlike 4 years ago, they won't have a big financial advantage. They far outspent John McCain. This time, when you put together Romney, the RNC, and the and is huge, all the outside groups, I think money will be close to a wash this time. Republicans might even have a little bit more, but Obama himself will have more than Romney, and it's better to be able to control your own money. This race will not be determined by money.
What influence do you think super PACs are going to have?
An insidious one. They're going to make the campaign more negative. They're going to be making charges, many of which won't be true on both sides. They're going to have all sorts of special interests contributing to them. They're going to have hidden agendas, but it's what is.
You know, Mitt Romney's private equity background, it's been such an issue in this campaign, and it seems that it's going to continue to be an issue. Why can't he go on the offensive maybe here and say, you know what, private equity is something that's part of our economy, and embrace it more as opposed to running from it?
I think the original mistake that Mitt Romney made on this was, and it's interesting because he's a very smart guy, and he made the same mistake 18 years ago. He said private equity was a job creator. It's not. It's a wealth creator. It helps teachers' funds, environment funds, and the like. But by setting that predicate, he opened himself up to legitimate criticism. But this race, in the end, is not going to be about private equity. It's going to be about the direction of the country for the next 4 years.
Yeah, and direction of the economy. Back to the money at stake. Is this going to be the most expensive race adjusted for inflation in history?
Yes. Well, I adjusted for inflation. I'm not sure. We go back to the days of Richard Nixon and, you know, black satchels full of cash. So I'm not quite sure about that, but it's going to be the most expensive, at least since then. And I don't think it's going to be particularly edifying. I'm fearful that a lot of it's going to be very, very negative, and that's going to make people even more cynical.
Al Hunt, thank you so much. We're back with the European close after this.
Live from Bloomberg headquarters in New York City, this is In Business.
Welcome back, everyone, to In Business. I am Trish Regan. Here's a look at our top stories that we're following right now for you. Facebook shares, they're expected to be under even more scrutiny today as short sellers will be allowed to trade for the first time. Facebook since its IPO, this stock has fallen sharply, and it's estimated that retailers have lost as much as $630 million in the IPO. Forgive me. Costco's another one we're keeping an eye on. Costco's gross margins improved for the first time in more than a year, boosting profits at the retailer. The Warehouse Club posted 89 cents a share in third quarter earnings, and that was actually 2 cents better than analysts had been estimating. So Costco, another one in focus. And Tiffany's cutting its full-year profit forecast as sales in North and South America came in less than expected. The retailer expects sales this year will be up 8%. It had previously forecasted a sales increase of 10%. Well, we're 2 hours into the start of trading right here. Let's get another look here at stocks in the U.S. You can see the market's pretty much trading to the, well, actually, we're starting to see a little bit more upside than we saw earlier there. The Dow Jones Industrial Average up 0.2%, a gain of almost 25 points. NASDAQ still in the red, but just slightly, pretty much straddling the flat line, while the S&P is trading up 3. We did get reads on durable good orders. Second month of decline there for durable goods. We did get jobless claims, which showed a little bit of improvement there in terms of the number of claims being filed, but still the real concern for traders right now still centers around Greece and whether or not Greece is going to leave the Eurozone. Let's check European stocks right now because you've got that session just ending right there, and we're seeing a move to the upside with the FTSE 100 trading up 95 points, a gain of almost 2%, CAC 40 up 1.3%, and the DAX in Germany trading up 34 points, a gain of a little more than 0.5%. To get a little context here on the European close, Will Hedden with IG Markets joins us from London, and Petra van Kussenbrock from Commerzbank joins us right now from Frankfurt. Will, let's start with you. We're getting a lot of negative headlines and a lot of negative economic data out of Europe, but yet you've got a market that's still closed in the green. Is this short covering? Is this somewhere, some relief somewhere? What's going on?
Good afternoon, Trish. Yeah, it's a little bit of a head scratcher today. We've seen the Greek market get really hurt, but in comparison, the major European markets are having a good day. I think there's a little bit of short covering. We've seen some of that. We've also seen a little bit of short-term trading. I think there's been quite a bit of intraday business that we've seen today that perhaps we might see peter out tomorrow. The volume hasn't been particularly good in comparison to the last 3 days, so I think that's possibly helping this rally look a little bit better than it really is.
You know, Will, one analyst earlier on the program said to me he thinks that Greece and an exit of Greece from the Eurozone is pretty much priced in to most of the markets. Do you agree with that?
Well, we would have been saying this some weeks ago that we would expect this to be priced in, yet then we still see, for example, the euro will still move a decent amount on kind of talks that when something happens in Greece. So I'm not necessarily sure that it is priced in fully. I think what today we've seen is a little bit of a rally getting carried away, and it wouldn't be a surprise to perhaps see that come off again into the weekend. You know, we had lots of pretty miserable data in Europe this morning, and it just seemed like the market was buying on poor data, which didn't seem to make a lot of sense to us.
It doesn't make a lot of sense. Petra, your take on this. Do you agree it's a head scratcher today, or do you just say this is some people covering their shorts and that's about it?
It's a stabilization of the market. It started a few days ago. Then there was this summit where we started to talk more about the Greek exit. Politicians somehow, for the time being, and the European Central Bank had been buying time, and so the market are stabilizing. Head scratcher, we have this high intraday volatility. We have had it for quite some time. We had been technically oversold, so we started very weak, and then the stabilization which we saw yesterday in the US market also arrived here in Europe. Yeah. I wouldn't say that the Greek exit is really priced in, but a stress test, more or less, that's what the markets are starting to make. The question is, what about the contagion? A lot of it already happened with a view to Spain, etc.
Well, I don't know about that. Will, I mean, has contagion really already happened? If Greece, in fact, leaves, isn't it quite possible that you're not just going to see bank runs in Greece? You're going to see them in Spain. You're going to see them in Italy. You're going to see them in Portugal. I mean, this is going to be a real issue, whether it lasts 48 hours, whether it lasts 2 weeks, whether it lasts 2 months. It's going to be a problem.
Yeah, I think the bank run problem, the bank run scenario is what we're kind of people in Europe are kind of worrying about now. That's the reality that people are facing, looking forward in Italy and Spain. And I think that there would be a certain amount of panic. We have seen big moves in bank share prices when this kind of story kind of gets some traction. So I think there probably is still some room left in those. And if we actually saw some kind of a bank run, then really at the moment we're still a little bit in the dark. We've seen it here in the UK in the last couple of years when the financial crisis started, and it wasn't particularly pretty. But I think it's going to be on a bigger scale if it does happen.
Bigger scale. You agree with that, Petra?
I would say I do count on the politicians as well. What we see that they repeat that they are favouring the European Union and they are trying to do their best to get it under control. We don't have any blueprint for such an exit, and that would be an external shock which would be very sharp and very bad for the market, and we saw that in the UK. I remember it well.
All right, we're going to have to leave it there. Thank you so much to both of you, to Will and to Petra, for joining us today. A little good news out of Europe in terms of those markets today. Bit of a surprise given all the economic news, but nonetheless, the market's closing higher there. All right, in today's options update, we are looking at Facebook shares. But a company, not looking at Facebook shares, I should say, but a company that's very closely linked to Facebook, for better or for worse for that matter, exchange operator NASDAQ, OMX, had some very high-profile problems opening up that trade for Facebook's IPO. That may be causing some options traders to take a bearish view of the stock. Dom Chu has more on this. Hey, Dom.
That's right, Trish. It's perhaps no surprise that traders and investors have been pushing down shares of NASDAQ OMX ever since that fateful Facebook IPO day. Just take a look at how the price action has been over the past couple of days here. The stock has fallen over 5% since the close of business back on May 17th, the day before Facebook's IPO. The trading issues really have led to some traders being more cautious on the shares. Put options or bearish bets on NASDAQ are gaining in popularity. As of May 21st, the number of outstanding bearish put options on NASDAQ OMX was 1.86 times, the number of outstanding bullish call options. Now, that put-to-call ratio, well, it was up 95% in just the last 4 days prior to that, and it was the highest number of puts relative to calls since January of 2010. Now, NASDAQ OMX Group won a very high-profile battle over who would be the primary listing exchange to carry Facebook, and that IPO that many called really the most important in an investing generation here. Some investors are concerned that this could have implications for NASDAQ's reputation or perhaps even hurt their chances of winning future IPO business. Now, earlier today, former SEC Chairman Arthur Levitt did join us on Bloomberg Television and weighed in on that particular topic. Take a listen here.
This is a failure of considerable implications for NASDAQ and its futures. No longer can they go out to companies and really say that they've cured the system. It's the best system. It's better than the New York Stock Exchange. It creates a more competitive landscape, which I think is good, but it is a severe setback for the NASDAQ market.
So, Trish, a severe setback, says Arthur Levitt, at the former of the SEC. So that may be a large part of the reason for that added bearishness over the past few days. So definitely keep an eye on those NASDAQ OMX options to see if that sentiment gets better or perhaps worse for NASDAQ, Trish.
All right, Dom Chu, thank you very much. The Supreme Court is expected to rule on President Obama's health care law next month. We're going to tell you how much is at stake for the insurance companies. And coming up, it was all smiles and laughs at the beginning. So what happened? We're talking to the lawyer who's suing Facebook over the company's botched IPO. Supreme Court is expected to rule on President Obama's health care law next month. We know it's a big deal for the insurance industry. Our analysts here at Bloomberg Government say $1 trillion in profit hangs in the balance. But which companies have the most to lose? Megan Hughes has a first look at what's at stake company by company. Megan.
Good morning, Trish. Yeah, this is a new Bloomberg government analysis just out this morning from our analyst, Matt Berry, and it takes a look at the top 10 publicly traded insurers, what's at stake revenue-wise from the individual mandate and the Medicaid expansion portion of the health care law. So let's take a look at what it found. The company with the most to gain or lose, Minnesota-based United Health Group, an estimated $68 billion in revenue. Now, this is between 2013 and 2020. Number 2 on the list, Aetna, $23 billion. Cigna, $12 billion. Humana with just under $12 billion. And Coventry Healthcare with almost $9 billion. Rounding out the bottom 5, you've got HealthNet, Amerigroup, Centene, WellCare, all, Trish, between $5 and $10 billion. In total, we're talking about $160 billion in revenue at stake, again, through 2020. Now, do keep in mind here, insurers will not get to keep all of that revenue if the law is upheld. Because of these medical loss ratio requirements, that means 80 to 85% of every premium dollar will have to go to health services. Now, the rest insurers can use for administrative costs and profit. So factoring that in, say, for United Health, that company would be able to retain an estimated $11.2 billion in revenue. That's during this 8-year period that we're talking about. On average, Trish, that amounts to $1.4 billion a year. That's 2.4% of United Health's revenue last year. Now, one side note, you may have noticed WellPoint, that's the second biggest insurer, not on the list. That's because of the way they report revenue to the SEC. Not enough of that data was itemized to be included in this study. But bottom line, big picture, all of the companies that we looked at, even when you factor in the medical loss ratio, we are talking about between 2 and 3% of last year's revenues. So a significant amount of money.
Indeed it is. Megan Hughes, thank you very, very much. Coming up, you're going to hear from the lawyer who's taking on Facebook over its IPO. He's going to make his case for why Facebook owes investors. Facebook being unfriended fast. Yesterday, a class action lawsuit was filed against the company by the personal injury law firm Morgan & Morgan on behalf of investors. For more, Morgan & Morgan's Peter Saperstein, lawyer for the case, is here with me now. Peter, a pleasure to have you on the program.
Thank you, Trish.
Tell me, what's the problem here?
Well, the problem here is that Facebook went through one of the most hyped initial public offerings in history. An initial public offering is a very, very big deal for a corporation, and investors are very interested in what's going to happen. And because it's a big deal, the rules are very strict with regard to initial public offerings. Initial public offerings cannot happen unless there are documents filed with the SEC. Those documents are called a registration statement and a prospectus. And the law is very clear that there cannot be a material misstatement or omission in a registration statement.
Okay, so are you saying or suggesting that there was a material misstatement in this registration?
Yes, we are saying there is a material misstatement in the registration statement. The material misrepresentation specifically revolves around the revenues and the discussion of the revenues, and it's both a misstatement and also an omission. And the misstatement and the omission are linked together here, and they deal with the revenues. And the evidence, if you will, that suggests that there's a misstatement is what took place surrounding the initial public offering. So the misstatement has to do with the discussion of the revenues in the first instance and the future revenues that were happening. There was an adjustment that was made by Facebook on May 9th, and they did warn to a certain extent that in fact revenues could decrease because, in fact, a number of their customers were transitioning over, were using mobile apps. But the company also said at the same time that while that could have an impact, that they had a strategy in place to monetize that the use.
Well, I mean, I got to tell you, I mean, we covered this for weeks ahead of time, and one of the big issues was how are they going to actually be able to monetize the mobile side of the business? A lot of people questioned that. We had a sell analyst on the very day the company went public, or rather an analyst who issued a sell the day the company went public, said there's no way that it can really justify a $38 a share price. But isn't that the risk investors take on? In other words, if you decide to buy that IPO, that's part of the inherent risk. Your stock price can go up or down. Why do you need a lawsuit to say, hey, this isn't fair, I lost money?
Because the lawsuit has to do with what is the material information that's being disclosed to the investors. And the issue over here is that while there may have been some rumblings around this issue, were the disclosures sufficient to advise the investors, to advise all of the investors that there were these kinds of material risks? And it's worse, Trish, because we're not just talking about advice about material risks. The evidence is quite clear here that the company actually knew what the numbers were and that the numbers were decreasing and that they had serious problems. So now you have this terrible juxtaposition, and see what happened over here, because while you're having your discussions, what do you remember happening with the IPO? All of a sudden the IPO gets raised in terms of the price. You had a $35 high end of the range first. During the roadshow, it gets raised to $38. That suggests that there's robust interest, good valuation over there. What happens in addition to that? The size of the offering
suggests a good valuation. In other words, it just suggests that there's robust interest.
No, it suggests
the market's willing to pay more for it.
Well, because they increased the valuation. They increased it. They said it wasn't 35, that the proper number was 38. And at the same time, what you have is a number of analysts who are connected to the offering, and they're getting information, or all of a sudden telling a few select customers that the information that they're getting from Facebook is exactly the opposite, is that the numbers aren't good. And you have Morgan Stanley, for example, which has an analyst who's a book runner, lead underwriter over here, cutting back on their projections for revenue.
Peter, what do you say to critics who say attorneys like yourself come out of the woodwork for opportunities like this, for a company that's made such a big splash that may be just willing to pay you to go away?
I think that each and every single person who says that should sit in my shoes and listen to the phone calls and receive the emails that I get from investors, both individual investors and institutional investors, who are absolutely furious at what happened here. The issue over...
On average, how much do you think your clients in a class action lawsuit will see?
Well,
from a settlement here? Or give me an example of another settlement that you've done, and how much do people actually see at the end of the day? Because the criticism is, of course, that the lawyers walk away with all the money as opposed to the individuals.
Well, the lawyers, and myself included, we have a duty to really maximize the return for the shareholders that we sue on behalf, and we try to do that. There are instances where the amount of damages are so great that the company can't realistically pay that. And what happens then is that they pay a percentage of what the real damages are. And that percentage then gets translated in that individuals who've lost money receive a percentage of their losses as opposed to their full loss. You know, our aim, Trish, is to make sure that each investor gets the maximum compensation, really gets as much as possible. And if you have investors who've lost money, we want to see two things happen, really. We want to see that the investors get back the money that they've lost, where we say that the losses have been improper because of improper acts. And also we want to send a message to companies that are making material misstatements in registration statements and conducting other improprieties that they ought not to do that.
So you're alleging this, in fact, was a material misstatement, and that'll be the basis of your case?
It is the basis of our case, yes.
Thank you so much.
Okay.
It's good to see you. Great
Thank
to have
you
you on the program.
Thank
All
you.
right, keep it right here in business. We'll be right back. We're going to go to the NYSE for a final check on these markets. See you on the other side of the break. All right, coming up on Surveillance Midday, David Kelly of JP Morgan is going to be talking to Tom Keene about U.S. economic growth prospects. Surveillance Midday is next. Don't miss it. In the meantime, we're getting a final check here on the markets. Let's head down to the New York Stock Exchange. Alex Steele with a look at everything. Alex.
Yeah, we're seeing a definite rotation into safety, Trish. Consumer staples telecom, utilities, biggest gains in the S&P. Apple has also turned negative for the day. Traders looking to see if that stock could hold on to gains, perhaps lead the market higher. Could not do that. Did take a turn for the worse on reports that the company's VP of Europe resigned on Wednesday. Also, traders wind up using banks as a proxy. Cannot find any momentum here. Have a slightly downward bias for the day. In particular, traders watching Goldman Sachs in the spotlight, holding its annual shareholders meeting today. Slightly negative shares right there. Shareholders reelected all directors and the pay plan approved by more than 94% of shareholders. But let's check out some movers, Trish, on the upside. Check out these airline stocks really flying higher. Look at U.S. Airways up almost 10%. Now, oil prices have seen a steep sell-off this week, down as much as 2%. But in terms of Delta, the company reaching a deal with unions, a 3-year agreement providing pay raises for more than 12,000 pilots. And Southwest, look there, up almost over 4%, agreeing to fork over about $100 million to expand Houston's William Hobby Airport, trying to start international flights from that hub despite protests from United. Trish, back to you.
All right, that's it for In Business. Tomorrow, Alejandro Ramirez. We're talking Europe and Latin America. I will see you at 3 o'clock on Street Smart today. Don't miss it.